You're now listening to episode 81 of the Real Estate CPA podcast.
Your source for all things real estate, accounting, and tax. Here we reveal our secrets that can save you thousands in taxes, streamline your accounting process, and help grow your business. Stay tuned to hear insightful interviews with industry experts, successful real estate investors, and current clients on what strategies they use to grow their business and how they steer clear of Uncle Sam.
Hi everyone, thanks for tuning in. Hope everyone had a great holiday season and is ready to crush it in 2020. We're back here today with special guest Frank Gallinelli. Frank is author of the best-selling book, What Every Real Estate Investor Needs to Know About Cash Flow, and 36 other key financial measures. Frank is also founder and president of RealData.com, one of the real estate industry's leading investment software firms, and teaches real estate investment analysis at Columbia University's Master of Science in Real Estate Development program. In today's episode, we discuss investment analysis and key financial metrics real estate investors need to pay attention to, including NOI, cap rate, cash flow, internal rate of return, and more. Also, if you stick around to the end of today's episode, Frank has a very special offer for the listeners of the Real Estate CPA podcast. Hey everyone, I want to let you know that we'll be hosting the first ever tax and legal virtual summit specifically for real estate investors coming up Saturday, February 29th and Sunday, March 1st. At this event, you'll learn about lucrative tax and asset protection strategies from the top legal and tax experts in the industry. Topics include the real estate professional status, cost segregation studies, 1031 exchanges, self-directed retirement accounts, entity structuring, estate planning, and so much more. Don't miss this incredible event designed to save you thousands in taxes and help protect the assets and wealth you work so hard to build. Head over to www.taxandlegalsummit.com and use promo code RECPA for 50% off your tickets. Again, that's www.taxandlegalsummit.com and use promo code RECPA for 50% off your tickets. See you there. But for now, we're going to jump right into today's episode. Frank, thanks for taking the time to come on the show today. Before we dive into due diligence, investment analysis, and all that fun stuff, can you give our listeners a little information on your background and what you're currently up to these days?
Okay, well, thanks for having me on your podcast today. My background goes back actually quite a bit. I've been in this field, if you want to call it that, for 40 years or perhaps a little bit more. And it was one of these sorts of things where one thing leads serendipitously and without planning to the next. If you want to go back that whole 40 years, I'll make this the short version of my CV. Started off as a math and English teacher, which was probably foreshadowing, now that I think about it, into a later life when I would write books and they would be full of numbers. But as a teacher, didn't make a whole lot of money, so started getting a secondary income from going into real estate, first as a part-time real estate agent, then morphing into a sales manager, first residential, then a commercial sales manager. And so there was serendipity number one, that the owner of the company for whom I was sales manager was one of the original prime movers of the Realtor CCIM program, which, if you're familiar with it, is the educational track for commercial brokers. And it was from him that I learned about income property and income property analysis. I learned about it and then ended up teaching it to the salespeople that I was supposed to be managing. So that's how, I kind of moved from one field into a completely unrelated field. But then fast forward a little bit, I kind of got drafted into a family business to help out with the financial side of it. And while I was doing that, I was also still interested in real estate, of course, and getting involved more and more with my personal investing. And at one point, I was trying to make sense out of a piece of commercial property that I was planning to buy. And it had some complications and some issues. And what happened at that point was that that event happened to coincide with the emergence of these funny little black boxes that later became called personal computers. So I got one of these things. I says, well, let's see if I can use this to do the same kind of analysis that I've been doing and teaching to my commercial salespeople in the past. And so I picked up something called a spreadsheet program. So what's this thing here? And built a model to try to analyze that property. And in fact, I did analyze that property, and I did 18 variations of analyzing that property. And some colleagues kind of looked over my shoulder and saw the stack of papers, and they said, how'd you do that? So once again, serendipity kicks in and says, well, if these guys are asking me, how did I do that? Then maybe I might be onto something here. And so a software company was born, like the company that I still own and run called Real Data. So we've been, it goes on maybe 37 years or so that we've been selling this software. So fast forward yet again a little bit more. And so we're in business maybe 7 or 8 or 9 years at this point, and sitting around talking about the kind of tech support questions that we get on a routine basis. And that's when we realized that a lot of the tech support questions that we have aren't technical at all, but they're from people who don't quite understand how this analysis is really supposed to be done. They don't really understand the type of financial dynamics that we're trying to sort out with our software, which leads me to believe then that maybe real estate investment education should be part of our mission. So the internet has emerged. I start writing articles online, and that attracts the attention of an editor from McGraw-Hill, who calls me up one day and says, would I be interested in writing a book? Of course, since I don't know anything about publishing, I don't know how grateful I'm really supposed to be. So I give the guy a hard time, but I ultimately do write the book. And that was the first of several, and it's the one that I think has surprised me in terms of how long it has survived, and certainly a surprise to the publisher in terms of how long it's survived. But I wrote it in 4 months, and it's hung in there now for 15 years. So I think I got my return on investment for the time I spent writing that book. And I think the reason it was successful, I mean, they sent me a sample they said, why don't you write something that kind of looks like this, maybe? So I took a look at the book they sent me. And again, having no understanding of the degree of respect I'm supposed to convey in this relationship, I said, I took a look at that book, and I can think of 3 people who can understand it, and I'm not one of them. So maybe I should write something, that's in plain English that regular people who have a reasonable degree of intelligence but no particular experience in finance or real estate would be able to understand. So that's what I set out to write, and that came trippingly off the tongue, as it were, and because I was just trying to say things in the plainest possible terms. So I guess that's how it came to be. Serendipitously yet again. So somebody picks up the book and talks to a fellow that he knows who happens to be director of a graduate program at Columbia University. And that leads me to being invited to teach this same stuff in the Columbia Grad School, which, I've done for I've taken the last couple of years off, but basically it's been about a decade and a half of my doing that. So as I said, the knee bone's connected to the shin bone. One thing has always seemed to have led to another. And the final connection there is that took a lot of the material that I put together for teaching my live and in-person graduate course and decided, well, this might be good material for an online course also. So a couple of years ago, put together an online video course that has fortunately gotten a good deal of attention. A lot of folks have been using it, and so that's out there also. So that's what's been keeping me out of the pool halls for the last 40 years.
Awesome. Great story. And we love the success of the book. Everybody who doesn't know the name of the book yet, it is What Every Real Estate Investor Needs to Know About Cash Flow and 36 Other Key Financial Measures. It is a book I believe every real estate investor should have on their bookshelf just to reference whenever you're analyzing a property. And that brings us to a good point. Every property needs to be analyzed before it's purchased, of course. But what sort of due diligence, what should investors be doing before they start to analyze a specific property?
Yeah, that's a very good point, Tom. The due diligence really should precede your getting out your calculator or your pencil or your software or whatever, because before you can start crunching the numbers, you've got to have some sense of what the numbers are or what they should be. And one of the things I see among beginning investors quite a bit is that they don't take the due diligence as a serious and important part of their preparation for investing in a property. And they also, when they do pay attention to it, they have a tendency to make the mistake of taking the information they've been given, taking it at face value, whether it's information they've gotten from a broker or information they've gotten from a seller. They just take it and they assume that, that's okay. And now I'm going to start working on whether or not these rents and these expenses justify my buying for the property for what they're asking for it. And I always tell people, don't take it at face value. Don't take it for granted that it's correct or that it's complete. Yeah, I can give you a whole bunch of what I feel are fairly obvious examples, but maybe they're not obvious to someone who's never done this before. For example, don't be shy about asking to see the leases on the property. Yeah, they've told you what the rents are supposed to be, and the information they've given you may be entirely correct, but it may not also tell you the complete story. For example, maybe it's a commercial property, and maybe you know what the current rents are, but are there steps that are going to occur where the rent is going to remain level for certain units for a certain period of time, then bump up to a predetermined new level? Or maybe there are options, and really you definitely would want to know about something like that. Maybe you've got a tenant in there who's at a rent that you think is perhaps a little below market, but when you get your hands on the lease, you find that tenant has options to renew at a continued below market rent. Something you may not know if someone simply gave you, a list of current rents. A lease could have what's called a kick-out clause. Maybe you've got a commercial tenant. It's not unheard of in a retail tenant situation where the tenant may have the option of getting out of the lease if they don't meet certain sales thresholds within a given period of time. If you don't see the lease, you don't know about that. So looking at those kinds of things, I think, are essential to doing your property portion of the due diligence. Same thing is true on the expense side of your due diligence. You could be told quite correctly what the current property taxes are, but have you been told if those property taxes maybe have received some kind of temporary abatement for some reason? Well, if you don't know, you won't know unless you ask. And this kind of information ought to be readily available from the taxing authority. Same thing is true with insurance. You may be given the correct information about what the insurance cost is, but that insurance cost, because the current owner has a bundled or a package deal with 17 properties, and that's why the insurance is this amount, or maybe they don't have any kind of revenue or rent income coverage in their insurance, and there's something you want. So get your own insurance quote instead of relying on someone else's. So this due diligence is a thing you have to take seriously, and you have to do it in some kind of depth. Another part of the due diligence that I really find that beginning investors have an unfortunate tendency to overlook is the market due diligence. No property lives in a vacuum. There are realities about where that property is that will affect its long-term performance, even affect its current performance. When you're going to evaluate it, you may need to know what the current market cap rate is, for example, for properties of that type in that particular location. You may need to know about what some of the municipal budget issues are that are going on. Is there a significant property tax increase on the horizon for properties generally, not just for this one, because they're building new schools or whatever? And you have to keep your ear to the ground. Same is true of employment data about the market in which this property resides. Are employers moving in? Are employers moving out? Can have a very significant impact. Let's say you're going to buy a multifamily property, an apartment building. If employers are moving out, what kind of effect is that going to have on the demand for apartments? So you got to keep in mind that the market has to have its own due diligence as well as the property.
That's a great point. And we've talked in the past about how do you analyze a market, both from a macro and a microeconomic perspective. And I think in this instance, we can talk macro in terms of the geographic location, and micro in terms of the actual neighborhood, if you want to play that granular. But one of the key ways, or one of the key resources that most cities and towns will have is something called a comprehensive annual financial report. It's a CAFR for short. You can literally just Google your city and then type CAFR, and you should see audited comprehensive annual financial reports from the city. There's a demographic section and a statistical section in each one of those reports that will give you a lot of really good information from a macro perspective. So really, really good stuff there. Now, Frank, kind of going back to the book. So you had 36 key metrics. Do I have to look at all 36 metrics whenever I'm doing the underwriting on any deal, or are there some really key hard-hitting ones that I always need to focus on?
Well, I wrote the whole book, so you ought to read it from cover to cover.
The entire thing. Otherwise, you are leaving something else.
But I think unless you want to have this podcast have more episodes than Game of Thrones, why don't we just focus on the really, really important items, and the other stuff we can save as kind of decorations for another day. Would that be okay?
Yeah. And so Tom and I kind of talked about this before.
Yeah.
We invest in real estate ourselves. And I'd be really curious to hear if you think that we're right or not. We think that the key metrics to know are net operating income, cap rate, DCSR, debt service coverage ratio, cash flow, and discounted cash flow, and then IRR, of course.
You must have been reading my notes.
Good. So that matches. All right. So tell us about net operating income. Why don't we step through each one of those?
Okay.
Well, briefly, let's talk about net operating income first, and we'll hit cap rate next.
Okay, yeah. This is actually what you just described. Thank you kindly for filling in the blanks for me here, because when I talk about this with my grad students, I always tell them that they've got to think in a linear fashion, that one thing kind of follows from another, from another, from another. And when you think in that way, not only do you have a better chance of reaching a bottom line, because, when you connect the dots in a line instead of a circle, you're more likely to end up someplace other than where you started. And also because you have a good chance, perhaps, of being able to explain this to somebody else, because there's a real good chance you might have to explain your thinking to a third party. So, yeah, NOI is exactly where I think I would jump off. Back when investors first learned to walk upright, which is when I learned this business, we used to use a form, and I still use this acronym, APOD, Annual Property Operating Data, which starts off with the revenue lines and then goes through the operating expense lines, and you subtract B from A, and you get the net operating income. Now, there's a couple of things I think that we want to think about when we're thinking about NOI. First of all, you've got that revenue line, and you've developed that by looking at the leases and making a reasonable projection of what it might be today and what it might be in the future. You subtract out of that an allowance for vacancy and credit loss. Now, even if you don't really, truly, in your heart of hearts, think you're going to have a vacancy, I always suggest that people still do this as part of their computation of NOI. And the reason is because other people are going to do it when they look at that property for some reason on your behalf. For example, a bank appraiser is going to make that allowance. So you make that allowance too. And then you've got to look at your operating expenses. And here's where, again, when I talk to novice investors, there's a couple of issues with operating expenses. One is understanding just what that term means. An operating expense is an expense that you have to pay to operate the property. So I can recall many times when we first went into the software business, people would call us up and they would look at this APOD form, which is kind of the equivalent of a business profit and loss statement, and they'd say, "Oh, your thing is all wrong here. You haven't accounted for mortgage interest." And I would say to them, "Well, thank you very much for your call, but you don't need a mortgage to operate a property. Therefore, mortgage interest should not be an operating expense because you don't use it to operate. You don't use depreciation to operate a property. So none of these things ought to be subtracted out when you're trying to figure out the net operating income." When you look at the expenses that you might have been given by the seller of the property or by the seller's broker, I think one of the most egregious errors that I see is that not only do folks have a tendency, as I mentioned earlier, to take the operating expense numbers at face value, but they also forget to look at that list of operating expenses and to say, what's missing here? For example, probably the most obvious example is that you'll see no mention of maintenance costs. Well, of course, you have to maintain a property. So if the seller hasn't told you anything about maintenance costs, this is the beginning of a conversation, clearly, that includes your physical inspection of the property or your inspection of the physical property, if you want to put it that way, and what kind of information you're being given. Does the physical property indicate that there's deferred maintenance, or perhaps it's recently been renovated to the extent that the maintenance needs are below what is typical, at least has been below what is typical? I think one of the most common missing items is property management. people will get a list of expenses and they'll start working on their numbers, and there'll be no entry for a property management expense. And they'll tell me, well, no, that's not a problem. I'm going to manage the property myself. Wrong. In terms of analyzing the property, that's a wrong step.
And that's just because at some point you might not be managing it yourself, right?
Yeah, well, that's certainly the case. At some point, you may not be able to manage the property itself. Life has a funny way of changing our plans. And so while right now, I might be perfectly happy to be climbing a ladder and cleaning the rain gutter, maybe I'm going to have somebody who's going to be over at that property checking whether it needs to be done, whether other things need to be done. So it may not be possible. But the fact is, even if I'm doing it myself, my time has a value. I mean, you go and buy stock. Let's say you go buy stock in Amazon or IBM or something. Well, they don't expect you to earn your return on that stock. They don't expect you to come and vacuum the hallways in your spare time. No, they have people who manage it. You don't have to have personal physical management of your other investments. So you shouldn't be assuming that your personal physical management of this investment is without some sort of compensation being accounted for. Perhaps even more to the point, even if you're anticipating a robust and active life, for the next couple of decades, and you have nothing better to do with your time other than to go over there and manage the property, the fact still remains that when you go to try to get that mortgage, the mortgage lender is sending out an appraiser to estimate the value of that property. And the process that appraiser is going to go through is going to include imposing or implying, if you have whichever is the right term here, a property management expense. If you didn't put one in, that appraiser is going to put one in for you. And that property management expense, that allowance for property management, even if you're not actually spending it and writing a check for it, that allowance is going to affect the appraised value of the property. So if you don't do it, somebody's going to do it for you. So I think you ought to do it before you get to that point. So when you do get to that point, you get down to that line called net operating income. And the reason that it's important is that it affects other things in the investment decision process. As I just mentioned, the appraisal, the appraised value. That commercial appraiser is going to come out and he or she is going to use that NOI and smack it against a cap rate and say, this is, in all likelihood, the current market value of the property. So if you don't have that NOI correct, your estimate of the current market value of the property is probably not going to be correct. So the NOI is an essential part of the process. And I'm not going to skip 2 jumps ahead on our checkerboard here, but we're going to see that it gets used in one of these other key calculations. Now, you had mentioned cap rate. So that connects directly to NOI. What do you use the NOI for? Well, you use the NOI to apply a cap rate and say, okay, I'm going to capitalize this income, and that should tell me more or less what the current market value of this property is.
Just to clarify, the cap rate, like if I don't finance the property, then theoretically the cap rate should be the dollars that I earn on my investment, right? So if I buy $1 million property for cash at a cap rate of 8%, then my net operating income is $80,000.
That's correct. Because cap rate is independent totally of financing. If you will, a more practical element or a more practical ingredient as we get down the road of our linear analysis here. But the value of the property should be independent of the financing, because the value of the property shouldn't change because you have good credit and can get good financing, and I'm a deadbeat and I've got to get expensive financing. And so does the property have a different value because you're a good credit risk and I'm a deadbeat? That shouldn't be the case.
And so what you're basically saying there is that the net operating income of the property is not going to change between you and I. The net cash flow might change, but that's going to be different than the net operating income because we have to take into account the financing and everything like that. So cap rate's independent of financings. We're just strictly looking at the net operating income. Now, if I identify, let's say I'm in a market with a 6% cap rate, and I identify a property that has an 8% cap rate, what does that tell me, or does that tell me anything?
Well, there could be a couple of messages there. The first one is that I think I want that property with the 8% cap rate, because what that tells me is that I'm paying less to get the same net operating income than I would have paid to get the one with the 6% cap rate. So on the surface of it, this is a good thing. The lower the cap rate, the more expensive the property is relative to the amount of return it's going to give me.
And don't mean to cut you off, but that makes sense. We have a lot of clients that are in very expensive cities, and those expensive cities will typically hover around cap rates of 2 to 3%, versus clients that are kind of out in tertiary markets where cap rates are still hanging out around 8%. Like I invest a lot in Hickory, North Carolina, and cap rates there are about 7 to 7.5%. But if you compare that to San Francisco, where they're at like 2.5%, your same dollar is not buying as much.
Yeah, and of course, if you happen to be in the same market and you see properties with two different cap rates, you start to ask yourself, well, what's wrong with this picture? Is one of these atypical? For example, is that one with a low cap rate? Are they simply expecting to get more than the property is worth? What is the prevailing market cap rate for properties of this type and in this location? Because there's no such thing as a good cap rate or a bad cap rate. Cap rates are entirely specific to their location and to the property type. So if this were an apartment building, the prevailing cap rate for apartment buildings in this 10-block area would not necessarily be the same as the cap rate for office buildings in that same 10-block area. So if you're going to use cap rate to help you judge what the property value might be, then you have to make sure that you're doing an apples and apples kind of comparison, that you're looking at the same kind of property in a very circumscribed location. But all those things being equal, if the cap rates are in fact unequal between two properties, then you have to figure that one of them is an outlier for some reason. If the one with the higher cap rate turns out to be the outlier, you got to start looking under the corners of the bed covers and say, okay, so why is the seller willing to take less than what the prevailing cap rate would be? Is there an issue? Maybe it's a personal issue. Maybe the guy's just got to sell, or maybe there are legal or functional issues with the property that make it less attractive, and the seller is having difficulty finding a buyer. So the cap rate can give you, kind of the canary in the coal mine kind of perspective on what's going on with that property. One more thing I want to say about cap rates, which is going to have a connection as we get a little bit further down our linear path here, and that is when you look at cap rate as a method of valuing property, you have to appreciate the fact that what you're doing here is exactly what an appraiser is doing, and that is looking at what we believe the market value of the property is at a point in time. At this moment, this is what I think the market value of the property is. So if we take a few steps back and start dealing with a little bit of a bigger picture mindset, we can say, okay, that is useful and helpful information, but is that the be-all and end-all of my analysis process? Am I simply concerned with paying something that seems to be the appropriate market value at this given point in time, or is my purpose in investing to get a return, a gain, a building of wealth over an extended period of time? So we're going to cycle back to that question in just a moment. Now, as we go on down, I said NOI was going to be useful in something else. And that something else is another metric that I find people have a tendency to overlook, something called debt service coverage ratio or debt coverage ratio. Okay? And that one's a pretty easy one to understand. It's a really easy one to calculate, and it's a bad idea to overlook this for a number of reasons. Debt service coverage ratio is simply taking the net operating income and dividing it by your annual debt service. Your annual debt service is that's a fancy term of art for the total of your annual mortgage payments, just principal and interest, mortgage payments. So what does it matter? Obviously, if the two things were identical, if your net operating income and your annual debt service were exactly the same, then one divided by the other gives you a ratio of 1. No place you go is that 1 going to be good enough. When your lender looks at that property and your lender looks at you as the borrower, they're going to say, no, one doesn't cut it. Because as I've said, I think a couple of times in my books and certainly in my online course and elsewhere, the chances of encountering unexpected expenses, well, those chances are a great deal greater than the chances of encountering unexpected revenue. So if anything's going to happen that's unplanned, it's that you're going to have more expenses than you planned on, not that you're going to have more rent than you planned on. So what your lender is really saying when the lender looks at your debt coverage ratio is that there's got to be wiggle room. There has to be margin for error. So if you're going to get this mortgage, you're going to have and be able to demonstrate that you have a reasonable anticipation of revenue in excess of what your debt service is. Well, how much in excess? Prior to the great meltdown of 2008, the typical answer to that question would have been that the debt coverage ratio should have been 1.20 or greater, meaning you'd have 20% more net operating income than you absolutely positively needed to have in order to pay your mortgage every year. Well, okay, so come the meltdown, that requirement typically got larger. With most lenders, it grew to maybe 1.25, even higher than that. So 1.25 means you would have 25% more net operating income than you really needed to pay the annual debt service, to pay the mortgage. Two key reasons why you care about the debt coverage ratio. Number one, if you don't have and cannot convincingly show that you're anticipating an NOI that's at least, we'll use the 25% benchmark for our conversation here, that you can reasonably show that you've got that, well, you're not going to get the mortgage. And if you do all this fancy financial analysis and you walk into a lender and you put the numbers in front of that lender and it shows that you've only got a 20% wiggle room, not only are you not going to get the mortgage, but you're probably going to embarrass yourself. Because the lender is going to say, why did you come in here? You didn't bother to ask before what our underwriting requirements are. So you're not only not going to get the mortgage on this property, but you're going to get some funny looks when you come in for the mortgage on the next property, because clearly you didn't know what you were doing last time. And of course, as a practical matter also, you care about this debt coverage ratio for the same reason the lender cares about the debt coverage ratio. That you don't want to be the person who is supporting your property because you didn't have enough money to pay the debt. The idea of investing in a rental property is that the property is going to support you. So if you're not acquiring something where you have enough money and enough wiggle room to pay that mortgage, if you're getting yourself into that situation, you're setting yourself up for having to fund the shortfall out of your own pocket, which is not why you invest in property or anything else. So debt coverage ratio, often overlooked, but shouldn't ever be overlooked.
So we've covered NOI, cap rate, the debt service ratio, the DSCR. Looking at cash flow, what do investors need to know about cash flow?
Some is good, more is better.
A lot more is really good, right?
Yeah, right. Okay. When you see negative numbers in your cash flow line, you have to start asking yourself, why am I doing this?
And real quick, Frank, I just want to parse out that cash flow. So sometimes we have clients that get a little confused, right? They see positive cash flow, but then when we report to the IRS what their tax position was at the end of the year, it's actually negative taxable income. Right?
And they should be jumping for joy. Yes. Yeah, right. They should be giving you group hug.
Right. But I think it's really important to understand that cash flow is what's hitting your pocket at the end of the day. So we want positive cash flow, but we wouldn't tell the IRS we actually lost money. So just wanted to interject on that.
Yes, absolutely. No, you're absolutely correct. Once again, getting back to my grad students, I asked them, of course, 15 years ago, everybody raised their hands when I asked this question. The question was, does anybody here have a checking account? Now, of course, everybody, does things with PayPal or, by smacking their phone on something or whatever. But they would always raise their hand and say, yes, I have a checking account. Well, cash flow is, you already know what cash flow is because you've got a checking account. The money you put in minus the money you take out is your cash flow. So it's money in minus money out. It doesn't make any difference why the money went in. It doesn't make any difference why the money came out. The difference is your cash flow. So if, for example, you collected rent or you took quarters out of the coin-op laundry machine in the basement of your apartment building or whatever, that's money in. Money out was for any of the operating expenses, for paying the mortgage, which did not affect the NOI, but now it does affect the cash flow. All of those things will reduce the cash flow. And
can you actually talk about that real quick, Frank? Because I think that like cash flow can really be summarized, like you said, by taking your money in and then subtracting the money that you pay out.
Right.
But how does that differ from net operating income?
Because not everything that you pay out affects net operating income. Your mortgage payments don't affect net operating income. Curiously enough,
parts of your mortgage payments affect net operating income. And what do you mean when you say mortgage payment, by the way?
The entire thing. That's the principal and interest. Neither one of those parts affects net operating income. Okay? They both affect your cash flow. One of them, the interest portion, affects your taxable income, but the other one doesn't. Okay?
And then we get back into the conversation of your interest that you pay versus my interest that I pay are going to be different, right? If we go back to that cap rate conversation, the interest, the reason that the mortgage interest is not in the net operating income is because it's going to vary investor to investor, but it's not reflective of the actual operations of the property.
Exactly right. It has nothing to do with how the property operates. One of the more curious things regarding net operating income, capital expenditures don't affect net operating income presumably because they are not necessary for the operation of the property. They may be necessary, for the long-term survival of the property, but at least from an industry standard point of view, they are not part of the operation of the property. So if you need to put a new roof on the property, that's not part of your net operating income. The most curious one is commission costs, which also are items, as I'm sure you're familiar, items that are normally capitalized rather than expensed, because they have presumably they reflect a life of more than a year. And that usually, I think, you guys are the tax experts, certainly not I, but I think that the usual touchstone is that costs that you have that whose life expectancy is more than a year are not expensed with real property, and costs which have life expectancy of more than a year need to be capitalized and treated as capital improvements or capital additions. So, for example, if I'm making a repair to something, that's an expense. But if I'm putting a new roof on, which has a 25 or 30-year life, then presumably that is not an expense.
Yeah, so that is right at the high level when you dive into the 2013 tangible property regs. We talked about this on a prior podcast if anybody's interested in looking that up. But when you dive into the 2013 tangible property regs, you have the betterment adaptation restoration test. And what a lot of that boils down to, at again, very generalized level, is materiality threshold. So if I make an improvement to a unit of property, let's say that I have 10 HVAC systems under one roof and I replace one HVAC system, I could pretty reasonably make the argument that I did not materially improve the HVAC system as a whole and therefore deduct that HVAC unit. But then the question becomes, so I can put that on the P&L as an expense rather than capitalizing and depreciating it over 27 or 39 years. 27 and a half for 39 years. But then the question becomes, well, how does that actually affect my valuation at the end of the day, right? So if I put it on the P&L, it's going to affect my net operating income, which affects my cap rate, which then affects my valuation. So we have to be pretty careful with a lot of that stuff. Yeah. But yeah, you can tax optimize and still, we see a lot of CPAs just automatically put that stuff on the balance sheet. And what we do is we ask the question of, well, does that actually make sense for the client?
Yeah. The irony there, of course, is that if you successfully expense that HVAC system, now you've reduced the NOI, so you've improved the property and reduced the value of the building, presumably.
Exactly. You reduce your tax exposure, but then you've got that lower NOI that you have to deal with later. So cash flow is cash in, cash out. That's relatively easy to understand at a high level. But what about discounted cash flow? How is that important and how does that play a role?
Well, now we're getting to really the heart of the matter, because as a real estate investor, you need to recognize that what you're really buying is not that pile of bricks that you're seeing on the corner. with the asphalt flat roof and all the rest of it. What you're really buying is an income stream. And on the assumption that you are a more or less typical real estate investor and are not buying a property before breakfast with the intention of selling it before lunch, you're more likely to be looking at the long-term hold, which means you are looking at a series of cash flows, not a single cash flow. Let's say, for the sake of argument, that your investment horizon with this property that you're looking at is going to be 7 years, which is not unusual, by the way. So you have a series of cash flows, the money in minus the money out for the first year of operation, the same for the second year of operation, the third, fourth, fifth, and so on. And then in the 10th year, you've got the same thing, plus you have one more cash flow, and that is the cash flow that you receive from disposing of the property, the cash you get out, the so-called reversion of the property. So you have a series of cash flows. And the interesting thing about them is that they are probably going to be all different amounts in each year. Certainly in the last year, you expect it to be a different amount if you're getting the sale of the property. And clearly, by definition, they don't all occur at the same time. The first year cash flow is occurring in the first year, and the second a year later, and the third a year after that, and so on. So we get into the whole time value of money discussion, which I'm sure is familiar to all of your listeners, and that is that money received in the future is less valuable than money you receive today.
Can you explain the time value? So money received in the future, less valuable than money you receive today. Can you explain that in just a very do you have a very simplistic example that you can?
Everything I say is simplistic. You apparently don't know me well enough. No, it is extraordinarily simple. Here's an example I use with my students. I say, you've all been so impressed with my lecture today, I tell them, that you want to give me a gratuity. One of you wants to give me $100 gratuity, as we leave this afternoon. The other, although equally impressed, is a little short of cash and is going to give me my $100 gratuity next year. I'm grateful to both of you, of course. But the person who gives me the gratuity today, I'm a little more grateful to you because unlike the other gratuity, I can take your $100 and invest it today and earn more money. So that when I get to the point 1 year from now, when I'm getting the $100 from your other co-student friend here, that other student is going to give me $100. So his or her gratuity is worth, at that point, $100. But your gratuity was actually worth more because I put it in a money market account and I earned 32 cents with it, or I invested in Chinese ceramics and I earned $32, whatever. But the fact that I had the money earlier meant that it was in my possession to reinvest. Whereas the longer I have to wait for it, the less value it becomes to me.
And if we really wanted to dive into that, which we probably should, but we could, if we really wanted to dive into that, you could also look at it from just the inflated value of a basket of goods, right? So a basket of goods today is worth, your $100 gets you this basket of goods today. But if you get that same $100 a year from now, you can't buy the same basket of goods because everybody in that basket of goods has increased their price a little bit to keep up with inflation.
Right, because those guys in Washington just got cranked up the printing presses, and now that $100 bill, doesn't buy me what I thought it was going to buy me. So yes, absolutely right. You can dive into it even a little bit deeper. But the time value of money comes into play here because we look at that future series of cash flows that come from the property. And by the way, it's the conventional wisdom is to look at them on an annualized basis, because if you try to look at the cash flows literally on a day-to-day basis when they actually occur, trying to figure out discounting your rent payments from the actual day you receive them. If you tried to do all those discountings, by the time you were done, someone else would have bought the property and the entire exercise would have been pointless. So we look at it on an annualized basis. So if we have to wait 1 year to get X number of dollars, we discount that X number of dollars back by some discount rate by 1 year. If we have to wait 2 years to get the next cash flow, we have to discount that one back twice. So that becomes even less valuable. 3 years, even less valuable because we're discounting it back 3 times. to get it to the present value. This is a present value calculation. So essentially, when we do discounted cash flow analysis, where it begins, and hopefully not where it ends, where it begins is we look at all those future cash flows. We take each one of them, and whatever amount that cash flow is, we discount it back by a discount rate, an opportunity cost, if you will. And we discount it back to the present. And we add up the present value of all of those future cash flows. And when we do that, we have what we believe is the present value of the entire income stream. So what we have is a value that says, if what I want is an X% return on my money, then this is what I can afford to pay for that income stream. That's the present value of the future income stream. And that's useful information, but it may be a little esoteric because it doesn't boil down the real worth of the investment from the point of view of, is this a good deal or bad deal kind of decision for somebody? And it also depends on your choosing an appropriate discount rate.
We discussed NOI, cap rate, debt service ratio, now cash flow, discounted cash flow, the time value of money. We understand that the internal rate of return is like the prized metric that a lot of investors use. How does this all tie into internal rate of return, and what is internal rate of return?
Okay, excellent question. So our present value discussion here, we got to a present value of the future cash flows, and we did that by choosing a discount rate. But where present value, I think, becomes a problem for many investors is deciding what is an appropriate discount rate. Internal rate of return is the one metric that allows an investor, a single number, if you will, that investor can look at, that takes into account both the timing and the size of all of the future cash flows. It boils it all down into just a single metric. And it's actually a lot easier to understand than most people think. I mean, we've been, marketing our software to investors now for, I think it's been something like 37 years. And from conversations with folks who use it, I get the strong impression that everybody agrees that the higher the IRR, the better. Except, of course, if the IRR is like 72%, in which case it means that you did your math wrong, because nobody gets that kind of an IRR. But they don't really understand where it comes from. Well, it's really just taking that same present value logic that we just saw and saying, I want to change the variable. With a present value calculation, we said, okay, I think I can reasonably estimate the future cash flows, including the cash flow from the sale of the property. And I'm going to discount them by a certain rate to decide what is the value of those future cash flows. What IRR does is say, starting off at the same place, I think I can estimate the amount of the future cash flows, including the cash flow from sale. But instead of choosing a discount rate, I'm going to say, no, I don't know the discount rate, which means I know the other variable. I know what I'm going to pay for that future income stream. In other words, I know how much money I have decided I am putting into this deal, how much I'm going to pay for it in cash, okay, over and above the financing, how much money I'm going to put into it. So I've got the value of the income stream. I've got the income stream itself. And so my question is, what single rate actually describes getting all of those cash flows with all of that timing? What rate, what one and only rate would I use if I were going to get X number of dollars the first year, Y number of dollars the second year, Z number of dollars the third year, and so on? Essentially, I'm finding the discount rate that says the future cash flows are worth what I'm putting into them. And that's all that IRR is. And so if a person has a sense of what is an acceptable internal rate of return for the type of property that he or she is buying, they can do that IRR calculation and say, okay, no, that's not high enough. And the only way I can get it higher is either to increase my projections of the income stream, which may not be a prudent thing to do, or reduce how much I have to pay for that income stream.
I've got a quick question. So, and this might be a little bit of a sidebar. We work with a lot of syndications and real estate funds, real estate syndicates and funds. And we see a lot of operating agreements, both when we work with the general partnership and also when we're working with the investors that are investing in all these deals. We see a lot of operating agreements that display their distribution waterfall, right? So it'll be like first your preferred return and then second X and Y and Z. Sometimes we see operating agreements that'll say, first we're going to pay all the limited partners an 8% preferred return on the aggregate capital that they've invested in the deal, which makes sense. But then the second step will be, it'll say, and then we're going to pay the limited partners an amount equal to like a 15% IRR or an 18% IRR. And then after that, it'll say, and then the general partner is going to get 40% of the distribution. The limited partner is going to get 60% of the distribution until a 20% IRR is achieved. And then it keeps going down. My question is, when you're buying a big deal, you're not going to get an 18% IRR until you liquidate, right? Am I right in thinking that your IRR is based on your outflows and then your inflows? And you're not going to get a big positive IRR until you receive the big positive inflow, which is going to come at sale. So really putting the IRR in a distribution waterfall in your operating agreements is not a good strategic move in most cases, unless that's literally what you're trying to model out. But then just understand you're never going to get past that step.
Yeah, I think, I share your apprehension there. I just don't see, without the final dissolution of the property, where you're going to generate that kind of cash to make those numbers work.
Cool. All right.
Yeah. So
I feel very vindicated right now. You got the famous Frank telling me that I'm right.
Well, I got to go take a look. We put a waterfall calculation into our software. I got to go back and take a look and see if our example has a way of making this happen. But I'd be reluctant to suggest that I can think of a way off the top of my head that somebody's going to achieve, that kind of an IRR.
Frank, maybe that's, and I don't know if you provide consulting services to these syndicates, but what we do is we see a lot of these attorneys that try to model the economics of the deal with legal language, but then we'll see things like that. And it's like, oh, that just shoots the entire deal in the foot, right? So maybe people just need to reach out to Frank to double check that their operating agreement makes sense before they sign it.
Well, it's like people who sell variable annuities for retirement. I mean, they're all based on assumptions that I don't think have ever been seen and, don't exist in in natural life.
Right.
And so I think this gets back to my entire due diligence conversation earlier, that, where did these numbers come from? Before you start crunching, and where did the source numbers come from that presumably would make any of this stuff happen?
All right, I'm going to popcorn back over to Tom. I think he's got one more question, and we'll close out.
Okay,
Frank, thanks so much for explaining the linear analysis of a property all the way from NOI down to internal rate of return. It's been amazing. But we understand that you have software that helps real estate investors and developers with your company, Real Data. Could you give us a little bit of an idea of how that helps investors, and then what the special offers you have for our listeners?
Okay, thank you. Yes, the software is what I alluded to at the very beginning of our talk, but it's gone through about 18 generations of refinement and improvement over those years. And that software does the kind of discounted cash flow analysis that we've been talking about. It allows you to build an APOD form to get to your NOI, and then to project out to as far as 20 years, if you want to, future potential cash flows. And we tell people, when you do these kinds of analyses, by the way, don't assume that you've got this kind of locked in stone. Do a best case, worst case, and somewhere in between kind of analysis. And the software makes that very easy to do, because it does all the heavy lifting for you. It does all those funny calculations that are needed in order to make these kinds of projections. So we have two versions of that software. One which we call our professional version, and one we call Express, which is for perhaps simpler properties and for folks who aren't into quite that level of detail. That is the pro version. So there's those two products. We also have a couple of products for developers that can allow them to do project cost analysis for a new development project, or a month-by-month development plan for something like a subdivision or a condo project. And then the latest thing that we had, and which is what my little special promotional offer is to your listeners, is the online video course, where I take all of these topics that we've been talking about and some more besides, development topics, some partnership topics, value add topics, and so on, all the key metrics. And I do that in a series of video lessons. And with those video lessons come, some extra resources, some little simple spreadsheets and checklists and quizzes to check your own progress through the course, and even a digital completion certificate when you're all done. So people can as we kind of anticipated when we got about partway through our career here in selling the software, it helps people with understanding these topics, understanding the metrics and how they work in real life. We have case study examples, made up cases that we take people through kind of step by step, doing these analyses in that courseware. So we hope that it helps people make more intelligent, more informed investment decisions.
Awesome, man. Could you just give us the promo code one more time? We'll go ahead and drop that in the show notes below for everybody who's listening out there.
Yep. Our software website is realdata.com. The educational component is learn.realdata.com. And the promo code is Real CPA 20.
Got it. Real CPA 20. So
20 for year 2020. Yes.
Awesome. So this is we're going to go ahead and drop that again. Everybody who's listening into the show notes. So if you are interested, go ahead and check that out. We'll also have the link to the website. And so Frank, thanks so much for coming on today. It's been an honor to have you on the show. We're big fans of your book. I think, like Brandon said, it was one of the first books that I've read. I have it in my virtual bookshelf, and I always take it back for reference. And I truly believe that every investor out there should really have it for reference.
Well, thank you so much.
Thanks for listening to today's show. If you enjoyed the show, please find us on iTunes and leave us a review. You can also email us at contact@therealestatecpa.com with any feedback or topic suggestions. We are always taking on new clients, and with the new tax laws in play, you really don't want to navigate this alone. Let us help you save money on taxes and with your accounting and CFO needs. To become a client, navigate to our client page at therealestatecpa.com and fill out a web form with as much detail about your situation as possible. Thanks so much for listening. Have a great rest of your week.